Well, good evening. Good evening. Welcome to my course, Group Accounting. I will share my screen now. And well, before I share the screen. So we will look at foreign currency transactions now, which are based on an entity level. So, well, there are 4 simple rules for valuing foreign currency transaction. So, because we will have to use different foreign currency translation rates. And well, the question is, in which situations would we use what currency translation rate? Now, when we are on the single financial statements level, so the single entity level, we have transactions in foreign currency. So we buy things in a foreign currency, and we sell things in a foreign currency. We pay payroll, maybe to expats in foreign currency, and so on. So these transactions in foreign currency have to be translated into the functional currency using those 4 rules. So first rule is when you have a transaction in foreign currency, that should represent the amounts of the date of the transaction. So when you have a transaction on 1st of July, you will use that rate on that day, so the current translation rate. So therefore, it makes sense to use the transaction date rate, okay? Because at the beginning of the year, the rate could be different from the middle and could be different from the end of the year. So when a transaction in foreign currency takes place, we just take that rate of that date. Okay, so I think that is a clear rule. When in the middle of the year something happens, you just take that date. Although, do you really have to go every day to the exchange, to the stock exchange, and look what rates are they offering or taking for foreign currencies? Well, there is no rule that you should take just the daily rate. You could also go for a weekly rate, and if the rate is not fluctuating too much, then you could also go for a monthly rate. So I've seen quite often in practice that the controller would just input an exchange rate at the beginning of the month. So that would be maybe the average of the previous month. And then all the transactions in a foreign currency will be made using that monthly exchange rate, okay? So you could say, well, on a certain day it will be wrong. Yes, well, it's different. And the question is it materially different? So is there a big difference between the transaction date rate at that day and the month, the average of the previous month? And when there is no big difference, you can, of course, take that. Okay, so that's a decision you have to make in the company. There are no rules for how to get to such a transaction date rate. If it's reasonable and if there is no big difference, I think your auditors will accept that. All right, but of course, if you have a big inflation or you have big differences in the daily currency rates, you should well think about looking at those rates more closely, and maybe define weekly rates or even daily rates. I have not seen hourly rates in practice, but daily rates I have seen. Okay, so the second rule is, and that is related to how close is a balance sheet item, how close is it to money? So when we look at, so we decide, or we distinguish, we separate monetary and non-monetary items on the balance sheet. So the second rule is for monetary items. So you should, if you have monetary items at year end, then those should represent the amounts at the balance sheet date. So therefore, it makes sense to use the closing rate at the date at the end of the period. So for instance, if you have a dollar bank account sitting on the balance sheet, and your reporting currency is Vien Dong, the Vietnamese dong, then you should use the closing rate at the end of the period, because you can easily go to the bank and exchange the dollars into Vietnamese dong, and therefore it makes sense to use the closing rate at the end of the period. Okay. But when you have non-monetary items, so what is a non-monetary item? Can you give me some explanation or some examples for that? Just put it in chat. What is a non-monetary item sitting in the balance sheet? Land, equipment, securities, yes. So these are well, securities, well, let's wait a little bit. It depends, right? So if it is a security, you can easily turn into money, and it's in the current assets, I think that's okay. That's that would be a monetary item then, if it's near to the money. But if it's if the security represents an investment, and and that is a long-term investment, and you don't want to get rid of it in the next future, then I would talk about a non-monetary item, because it's not so near to the money. Okay, so we will distinguish between these things, because IFRS rules that any item that is near to the money will be translated using the closing rate at the end of the period. Any non-monetary item, such as land, and also inventory, will be translated at historic rates. So that causes some problems, because you will value assets and liabilities with different rates. So you, in the end, if you have a balance sheet and you will translate it with different rates, so that will be happening. There will be an imbalance. There will be a difference between all the assets and all the liabilities, including equity, right? So we have to do something with this translation adjustment, and where we will put that into the balance sheet, into equity. We will come to that. But just let us look at the simple rules. So all transactions at the transaction date rate, all monetary balances at year end at the closing rate, all non-monetary balances at year end should be valued at historic rates. Well, if you have a revaluation going on or an impairment, then of course you should use the rate at that impairment or revaluation date. So what about the foreign exchange difference? Well, any foreign exchange difference is considered to be a realized gain or loss, and therefore it will go directly into profit and loss, and as a consequence included also in equity in retained earnings. So these are the four rules that we have to apply when we are when we have transactions that will be translated into the functional currency. All right, so let's do an example. So please go to the breakout rooms. Well, I will send you there. And then please read the foreign currency transaction case study. And then, well, we will please prepare the necessary calculations and recordings and use the, I think there is a form. Yes, there is a form on the next, and the next, or we should just do this one. So use this form to come up with the calculations and the debits and credits. Okay, so I will send you to the breakout rooms now. So we're back from the breakout rooms, and what we did, we looked at the foreign currency transaction of the Willems firm. The first table should look like this. And I saw that a lot of you, well, without or with my help, came to the right conclusion. So we have a transaction here in foreign currency. We had to translate those transactions at the transaction date rate to the liability. So we are able to record in the functional currency. So that is the dollar in this case. We have a liability of 40,000 by the importing of the machine. We repaid in part only 180,000. So 220,000 is the year-end closing balance in the foreign currency, in dinar. We have to translate that at the closing rate into 27,500. But when we look at the balance before any exchange rate differences, we would see that we have a liability originally of 40,000. We repaid in part at a transaction rate of 7.2. So we repaid 25,000. And in the end, at the year end, we have a balance before exchange difference of 15,000. So now we have to look at what is the real liability. Well, when we take the actual dinar, because that is what the company will have to pay to the supplier of the machine, and we translate that at the closing rate, we have a liability of 27,500, which is higher than what is in the books. So we have to book for the difference, which is an exchange difference or an exchange loss, in this case, of 12,500. So I think the company would have been better off if they had paid the total amount using 7.2, right? But okay, that is life. Okay, and when we look at the booking entries, well, that one was the buying of the machine, 40,000 credit liabilities. Then the repayment of 25,000 would decrease liabilities and decrease the bank account. Then we will have to revalue the liability at 27,000 and book that foreign exchange loss of 12,500. So it will increase the liability again by 12,500. And well, the fourth line, if you wondered what is this for, well, we had to, when we import a machine, of course, at the year end, we have to depreciate that. If we had not done that in a monthly balance sheet. So we have to do that at year end. And you were right when you said, well, it's only for 6 months. So we have to divide 40,000 by 10. That is the annual or 12 months depreciation. For the first year, we have only 6 months. Therefore, we will divide it by 2. And the resulting booking entry would be debit depreciation, which is a cost of goods sold item, and then credit machines. So we will reflect the decrease in value of that machine. Okay, so that was part 1. Now please go to the next transaction, and please use this form to come up with your suggested solution. And well, now we can talk about the solution. Here is my suggested solution. The transaction under B should look like this. Well, you have 2 sales transactions, one 360, the other 540. So the total transaction in foreign currency is dinar 900,000. So you would use the transaction rate to the transaction date rate to translate the foreign currency transaction into the functional currency. So you have a receivable from the first transaction of 50,000, 60,000 from the second transaction. And at year end, well, the customer has not paid. So we have a balance in the bookkeeping of 110, but they reflect, of course, 900,000 dinar, which the customer has to pay. So the year-end closing balance, when you look at the dinar translated at 8, should read 112,500. Well, this is 2,500 more than what you have in your bookkeeping. So we have to account for the difference, which is a gain, and we will debit trade receivables by 2,500 and then have a foreign exchange gain of 2,500. And what else do we have to record? Well, we have to record the sales, which is this one, 50 plus 60. So it's 110,000 trade receivables. We will debit trade receivables by that amount and then credit sales. So that is the first line, reflects the transaction to the customer. But we don't get 110 profit from the customer because we lose something, right? We have to sell our inventory, which we had before, and that inventory was valued at 80,000. So we would credit inventory because that is decreasing our inventory, decreasing our asset inventory. And then we will put that decrease of an asset as a cost into the profit and loss account, which is cost of goods sold. So these two lines will determine the profit. When you look at sales minus cost of goods sold, that is 30,000. So when you look into the P&L and nothing else happened, then you have a profit of 30,000. But when you also look at the trade receivables, while you have 110, you gain a receivable of 110, but you lose inventory of 80,000. So what's the difference? Difference is a profit of 30,000. And here you can see the advantage of a double booking, a double entry booking system, because in the P&L and in the balance sheet, you have the same profit. Okay, and that's why it's called the double entry booking system. Well, you could also do that in a single entry booking system, but then you would not do it twice. Okay, I think that's okay. Or are there questions? No questions? Okay. Well, then let's summarize what we have seen in these two tables that we prepared. Well, we first show revenues of 110. All items are in dollar because that refers to our functional currency bookkeeping. So revenues 110, cost of goods sold 80,000, depreciation 4,000 plus foreign exchange loss on the liability is 16,000, and we had a foreign exchange gain on the receivable of 2,500. So in all, we have cost of goods sold of 94,000. So a gross profit of 16,000. And well, that was the income statement. When we look at the balance sheet, well, we have the machine. We bought it at 40,000. We had a depreciation of 2,000. And then a balance sheet, in the balance sheet, it will account for 38,000. The receivables we got for 110, but in the end, they were worth more because of the foreign exchange gain. So we have 112,500. And well, on the current liabilities, the companies made a loss of 12,500. So at the end of the year, we have a balance sheet item for the current liabilities of 27,500. Okay. Questions? No? Okay. Then it's already 7 o'clock in Saigon. The sun is below the horizon, I think so. And well, in Germany, it's still 2 o'clock, so I have half a day left. I will go now to the University of Rostock because we will have a barbecue meeting there. So I invite you. If you're quick, you can be there. But okay. So tomorrow we will look at what we have seen so far. We looked at the individual company level, the foreign currency transactions. They are translated at the exchange rate when the transaction takes place. So that is the rate of the transaction or transaction date rate. For non-monetary items, at the end of the year, we will use the historic rates, property, plant and equipment, inventory. So we bought inventory, we bought machines, and we did not reflect any difference in foreign exchange rate at the year end. So we would not revalue the machine, which we have bought in dinar. We will not translate that at the closing rate. So we just leave the items that are non-monetary, we leave them at their translated transaction date rates, okay? So non-monetary items. For monetary items, we will retranslate those at the closing rates. So when you look at receivables, they are very close to money. The liabilities you have to pay are also very close to money. The loans, the cash at hand, the bank accounts, and so on. All these kind of items of assets are near the money and therefore called monetary items. And we will retranslate them at the closing rates. Well, the exchange rates then are recognized in the statement of profit or loss. So just put them there and that's it. Okay, having said that, I will close today's session and we will go on with the foreign currency translation at group level, and we will be looking at that tomorrow. And we are also looking at what you will expect in the exam. I will make some remarks regarding that. And if you want to, we could also do a mock exam tomorrow. Okay, so we're 30 people. I could put you into 30 breakout rooms so you can work on those things all by yourself. Would that be okay? All right, so then see you tomorrow and have a good evening and enjoy dinner and well, no party, huh? Party only after the exam. So see you later. Bye-bye. See you tomorrow. Lam, are you still there? Lam Dien? Lam Dien Le? Are you still there? Because he or you had a question. Okay, so maybe I will answer it tomorrow. Bye-bye.